Hi all. In my previous video, we did some of the ratios related profitability and return ratio. In this video, we'll be doing the asset utilization related ratio. When it comes to asset utilization, we can say how the company is using them asset to gain the revenue. So this is a short term of asset utilization. When it comes to asset utilization, we have a first ratio is asset turnover ratio. This ratio mainly saying using the one USD of asset how much the company is earning the revenue. Let's calculate the asset turnover ratio. To calculate turnover ratio, let's take the revenue from income statement. This is our revenue. This is our total assets. Let's take the total assets from balance sheet. This is our total assets. So here we can see the for one USD of total asset, the company is earning 2.38 revenue. Another things we have a PPE turnover. So to calculate PPE turnover, let's take the numerator as a revenue. We can get the PPE from balance sheet. In our balance sheet we can find the pp from here. So here we can say for the one USD of pp the company is earning 3.46 USD of revenue. Now let's see about our debt ratio. This is cash turnover ratio. This ratio mainly say that how much we are earning from what we have as a cash. So we can calculate case we can get from um, current assets. This is a case. So we are gaining 53.16 revenue for one USD of cash that we have. Another thing, case days. To calculate case days, we can get a case multiplied by 365 and also divided by revenue. To get this much of 53.16, we are getting roughly 7 days. So another thing we have account receivable turnover. So to calculate account receivable turnover, let's take the revenue. Also, we can get the account receivable from current assets. So this is our account turnover ratio. For one USD of account receivable, we are earning 71.65 USD of revenue. Now let's see about account receivable days. Mainly this ratio is saying how many days we are taking roughly to get this much of account receivable turnover. So let's take the account receivable from here multiplied by 365. So denominator is our revenue. We are roughly taking 5 days to get this much of the account receivable turnover. Now let's see inventory turnover ratio. We can find the cost of goods sales from the balance sheet. Hmm, our balance sheet is here. Yeah, we have to change this as a positive. Yeah, we changed. Another thing, we should get the inventory from the balance sheet. Hmm, our inventory is this much. So our inventory turnover is 7.5, and roughly we are roughly in a specific year or specific year we are selling the specific goods and replace the goods in stores 7.51 times. When it comes to inventory days, we can get the inventory multiplied by 365, also divided by cost of goods sales. So this is correct. Yeah. Roughly to make this specific inventory turnover, we are taking roughly 49 days. Now let's say about account payable turnover. For that, we can take the cost of goods sold. Denominator is account payable. We can get this from the current liability. Yeah, here we can see that we are paying the account receivable 6.0.8 times. for a specific year. We can see the other things, account payable days. To calculate account payable days, multiplied by 365. Also we can add the cost of goods sales. Yeah, it's roughly 60 days we are taking to pay our debt. These are the all ratios that we have calculated under asset utilization. So let's calculate all the year. For that, let's select all and control R. Now we have calculated all the ratios for the all year. Now we can see that these are the ratios that we have calculated currently. Also, this is a benchmark. Future we'll be seeing the other ratios as well. Let's get touch with us. See you soon. Thank you.